Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. Stocks were down sharply Friday morning after President Trump announced 35% tariffs on Canada. Ross is concerned it could be the start of a major correction. He checks out gold, crude, and the U.S. and Canadian dollars. Founder of the trendletter.com, Martin Straith, chats about the tariff wars, the Russia-Ukraine conflict, gold, Bitcoin, and how stablecoins might be used to erase government debt. He also has a special offer for our listeners. Publisher of the Schachter Energy Report, Josef Schachter, drills deep into the energy sector. He examines some of President Trump's energy deals and where the energy sector is going. He also talks about the sudden drop in copper prices due to tariffs and Canada's relationships with the U.S. and Europe. We'll chat with Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Pleasure to be with you, Jim, and a little more excitement this week.
Well, we had record highs in the stock markets last week, but Friday's opening down drastically after President Trump announcing 35% tariffs on Canada late Thursday night.
Yeah, and tariffs sort of across the board. Anyone who hasn't signed with him is now going to get the tariffs that they were warning about. And I guess, a lot of people might have been thinking that he would move the date once again, but they didn't. They followed through on this. And, here we are. The S&P and the NASDAQ, not only did they make new highs last week, but they had new highs as of early yesterday. So that's record highs. Poor reversal to the downside late yesterday, and follow through, as you said, today. This then turns it into an outside reversal week. So that's taking out the high of the previous week and then down below the low of the preceding week. And we've had maybe half a dozen examples of that in the last couple of years. The most recent one being the February high of this year. And the reaction that we've seen out of that has been downside of 2 to 3 weeks, and in some cases that put in a final low, and then the market, once again, because it was a bull market, was rallying to new highs. The exception of that was the February reversal, which, yes, did take us down for 3 weeks into the initial low in March, from which we got a pretty decent bounce and then continued down. So that the total break there was about 7 weeks in total. But the first three put in an interim low. So with what we're looking at right now, we've been looking at the markets making this just methodical uptrend since the bottom in April. I mean, and historically, this was one of the biggest percentage gains in such a short period of time. We've been looking at the fact that it was up 25% in 60 days, and that, once you got the reversal, you could get a really hard break historically, and we've done the research on that, which I'll publish this weekend. The other thing that we've been doing is that, in a methodical trend, you'll typically come back and test the short-term moving average maybe 2 to 3 times and then go to the longer term. In this case, that's the 20-week or the 20-day moving average. And since we turned off the bottom, we had tested that 4 times, the last time being July the 16th. And when you break that, then you look for the, as I say, the move then to the next longer term, which in this case in the S&P would be the 50-day moving average, and that would take us down to about 6150. And as of Friday, we're at 6228. So there's still room to go on the downside there, but it's natural for you to have that type of a correction after you've had a methodical uptrend. So we'll look for overall, because of the outside reversal week, 2 to 3 weeks here on the downside, and who knows how deep it will end up being. Could it correct 38 or 50% of the move from the April low? Let's let it run its course. We'll look for some bottoming signals in a couple of weeks here, but for now, maybe it's time for the inevitable correction that we haven't had since the April bottom.
What's going on with gold?
Well, gold had that for us the good upside and exhaustion high back in April, and we had the first hard correction, and then as of the last week or so, it had bounced back and was retesting the highs, not right back to those highs, but we were back to 3,400 and change. And at that same point, we were starting to get some pretty good signals as far as things like the U.S. dollar was concerned. And so that meant that there was a high probability that for all that gold was trying to break out of its triangle that it had been trading in, it didn't seem to have the momentum to push through there. And the move in the currency was suggesting that we would probably be back down testing the lows. Now, silver and platinum and palladium, a week ago, we got some really nice sell signals there, looking for a hard correction back to their 20-week or 50-day moving averages, and those three precious metals have really taken it on the nose here this week. We've had some pretty good breaks. That's put us into short-term positions being oversold. Now, the most recent rally in the dollar index up to its 20-week moving average had been what we expected off that capitulation low a month or so ago, and that was in place. So that then put in what I think will be a very short-term low as far as these precious metals are concerned. But if the dollar, which had, as I say, been up to its 20-week moving average, at around par, if that breaks through there on the upside, then I think we can go all the way up to about 102. And if we were to do that, that would be a level at which I would consider the precious metals to be looking for a significant bottom that could have a very concerted move to follow on the upside. But for now, short-term bouts as far as I can see in the precious metals, but not one that you would want to stay around for at least for traders, for more than a 38 to 50% retracement rally.
What's going on with crude oil?
The crude had a darn good bounce here. As you know, I haven't had any strong opinions in this one. We had some sequential nines back around 64.5. This rally took us up to 69, but it's just biding its time. There's a seasonal uptrend in here, but I think that could run its course pretty soon. I'll let others who have a real specialty in that area, I'll fall back to their analysis and let And just for me, it's something I don't really see anything strong in the way of signals right now. So I just pass on that. I would say that the one that's starting to turn very nicely here is the bond market. We put in some good signals around the lows here on the middle of the month, around the 17th, 18th. And at this point, we're getting a great-looking base, so I would think the bond market has got pretty good potential on the upside for the next couple of weeks.
The Canadian dollar, how's it doing?
Along with every other currency, has just taken it on the nose in the last couple of weeks here. And we're, trading around 72 and change right now, having been up to 74 and change. But I think the key that we want to look at is that the divergence on the most recent high. We rallied 3 times here, up around 73 3/4, and the most recent 2 tests of that were at progressively lower highs, and that's happening while the crude oil was bouncing back pretty well. So anytime that we see a divergence in the CRB index and crude versus the Canadian dollar, it tends to then, it would be a negative signal. I mean, this offsets the positive divergence that we had back down at 69 in March. And so now we've got this negative divergence up here. At this point, I would think that the Canadian has reversed that overall trend and probably has more potential on the downside after a bit of maybe a bit of a bounce in here right now. But overall, I would say the sell signal is back in place.
The metals, copper last week had a record 20% drop after tariffs on copper were announced in the U.S. Has it come back?
No. The copper market, when they put the tariffs on, we had the run up to 580, which was just a monster move on the upside. And now when they've come out and said no, that it's going to be any refined copper is going to be exempt from the 50% tariff. So, we had this market just fall out of bed. We're trading around 443, down from 590 at just a week ago. I'm getting some strong signals, oversold signals, as you would expect. This is the same type of signal that we got on the April 7th low. So I think there's a chance for a pretty good bounce as far as the copper price is concerned. And, maybe this will be the low from which the next major rally happens. But this is definitely one to look at with potential on the upside. And, from that perspective, take a look at the miners. For all that they came under pressure after the announcement of the first tariffs, they at this point are starting to look like they're getting a little bit oversold. As I say, maybe they're good for a bounce, but if the equity market as a whole is going to have some pressure for 2 to 3 weeks, I'd be patient in terms of looking at buying any copper stocks.
Ross, thank you so much for the update.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on X at Charts by Ross. Coming up, Martin Straith next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Martin Straith, founder of Trend News, online at thetrendletter.com. He's speaking to us from Coquitlam, BC, which is just east of Vancouver. Welcome back to This Week in Money.
Oh, my pleasure, Jim. Thanks for inviting me.
President Trump announced a trade deal with the EU with 15% tariffs. Just before the weekend, he announced a 35% tariff on Canadian goods not covered by the USMCA agreement. What's your take on this latest tariff bid?
Well, it's interesting that all these deals that have been announced are, they're really more of a framework of a deal. There's certainly not a whole lot of details being put out there. Because I don't think they've all been worked out even. So the EU framework is for a 50% tariff on EU goods entering the U.S., while U.S. goods entering the EU have no tariffs. So, I mean, what Trump does, he's the art of the deal guy. He sets these like higher tariffs, so 25% on the EU, and then he makes his big concession and settles for only 15%. And as you said, he announced that he's raising the tariffs on Canada from 25%, which has kind of been his normal hit, to 35%. And that's part of the game he likes to play. He loves to play the big bully. And because he's negotiating from a position of strength. It's really hard to say how the Canadian-U.S. agreement is going to end up. Probably somewhere in that 15%, like the EU. There's still so much uncertainty about the so-called trade agreements. Like I say, there's no real details, just framework, just proposed terms. If we look at the EU framework announced, U.S. car manufacturers, they will have full access to the EU market, while European car makers they're going to be hit with a 15% tariff. So, and let's remember, it's the U.S. importer who's going to pay these tariffs. And then they're going to have to decide how much of that 15% do they pass on to the consumer. And then, of course, that importer is going to come back to them and negotiate with the EU manufacturers and try and get them, to offer some discounts off their prices. And I'm sure they're probably going to aim for a 15% discount so that there's no real hit on their end. So we'll see how it all works out. But, you have to be, at least I am, a little skeptical with Trump. I mean, is he even going to honor their part of the deal? We don't have to think very far back. When he was first in power, they negotiated the U.S.-Mexico trade agreement, and Trump, called that the greatest trade agreement ever. And then here he is as he gets reelected. One of the first things he does is sign executive orders, to apply tariffs on Canada and Mexico and a bunch of other places, claiming national security, and for Canada saying that, we're allowing fentanyl to come into the U.S. And so that was his justification. So it's going to be very interesting to see how the Canadian and U.S. negotiations work out. One of the things I think that's going to be very key is how do the consumers in all of these foreign countries react? It's fine to say that the U.S. producers will have full access to the foreign markets. But I mean, how pissed off are the consumers in these countries at Trump and the U.S. for strong-arming these deals? I mean, we've certainly seen here in Canada, there's been that very big, Canada first. There are many Canadians refusing to travel to the U.S. or to buy U.S. products. So I got to tell you, though, I mean, here we are, 1st of August. It's a bit of it's a bit tiring to listen to Trump's daily threats and rants. I mean, this is summer. I wish the guy would take a vacation. So hopefully we can get some kind of closure here, and soon would be better.
The stock markets have been making new all-time highs, but Friday they opened sharply down, and you noted in your market pulse, which is free, that the NASDAQ and S&P 500 each had an outside reversal lower. Can you explain what that means for our listeners?
Yeah, well, I'll try. And just so your listeners know, they can simply go to our blog section of our website, thetrendletter.com, and they can see the charts. So the charts really make it pretty easy to understand what happened there. But and they can also sign up for the Market Pulse, which is, like you say, it's free, and just send a note at info@thetrendletter.com, and they can get on that list. So what we had, just as you said, we had both the NASDAQ and the S&P 500 have an outside reversal lower. So here, let's try and walk through that. So what happened was Wednesday night, so the night before, we had after the close, we had both Meta and Microsoft announce their earnings, and they were stellar earnings, fantastic earnings. Then on Thursday morning, we had the markets open higher based on those earnings. So the market loved that. But then what happened is the market started selling off. And it closed the day below the previous day close. And that happened, as I say, to both the NASDAQ and the S&P 500. So that means they both had an outside reversal lower. So specifically, here's how that works. So the term, the outside day, so what that means is that the day's high is higher and the day's low is lower than the previous day's range. So what it's doing is it completely engulfs the previous day's total trading range. So higher high and then lower low and then closing there. So the reversal lower is when the index closes below the previous day's close despite opening stronger. So then you go, well, what does that mean? What does that suggest? Well, what it suggests is the early strength in the morning was overwhelmed by selling pressure. And so what that's telling us is that it's showing a loss of momentum. And then the outside reversal to the downside, that it often acts as a short-term warning, especially during, extended rallies, which that's what we've been having. So you got a warning, and then you combine that with heavy volume, and that adds to the conviction of the bearish setup. Now, this doesn't guarantee that we just saw a market top, but it certainly raises, the caution flag that a pullback or at least a period of consolidation is, probably going to happen. And certainly today, the markets, what we're at here, we're just about at the close, and, the S&P is down 100 points. So that just kind of shows that, the market does tell us likely what's going to happen. So now if we do get a significant correction here, it's probably going to be short-lived, as the last few corrections have been kind of V-shaped. So we'll be watching for that. We've got all these trade agreements and announcements this week. So to start off the week, we had that optimism that the global economy was going to expand. Then, of course, today we had Trump announce all kinds of these higher tariffs for dozens of countries, including, the 35% for Canada. And then Switzerland, he threw on a 39% for them. So even if he finally settles at 15% for most countries, that is still inflationary. Somebody has to pay that cost. Tariffs are a tax. They're not just free money that comes out of nowhere. Somebody pays for that, and that's inflationary. So lots of reasons for the big drop today. And on top of everything else we were just talking, you had U.S. jobs data that was very weak. But even more importantly, the previous numbers were revised quite a bit lower. So then you've got all the uncertainty. Again, Trump's just ramped up the uncertainty again. So that's certainly added to it. But the other big part is this market was already overbought. Valuations were sky high. So even without the trade concerns or the job data, we had been watching and warning about a bunch of things. So we had a list of things that we were telling our subscribers. Now, again, we just had that outside reversal that we sent that message out to our subscribers. That's a bearish warning. We had 3 consecutive down sessions in a row this week. And then here we are on Friday, which is the biggest down day yet. So that's 4 in a row. That's bearish. Now, when I was last on, we talked about that I highlighted there's a 95-year trend line that's proven to be incredibly strong resistance. So if you drew a trend line from the Great Depression high in 1930 and you ran it up to today, you'd see that it got tested all along the way. It tested the .com, the financial crisis, and it tested earlier this year, and it's testing right now, but it has not broken through. The S&P it touched it, and it's the last couple of days it's now turned down. So we'll see if it finally breaks through. But so far, that was a monthly chart. The month has ended. It did not break through. Now the market's being driven by animal spirits, fear of missing out. So that's a whole momentum thing. Those can be dangerous. When they can turn quickly. And then Wednesday, we had Microsoft. It joined NVIDIA with a market cap of over $4 trillion. Now, you got to put that into some kind of context here. $4 trillion is equal to Germany's gross domestic product. So what we've got here is we've got 2 American companies. Both of them have a market value that's equal to the biggest economy in Europe. So, it's frothy. you add into that, we got the Mag 7 stocks. So we got 7 stocks of the S&P 500, just 7 of them are now worth 50% of the S&P 500 market capitalization. And so the question then is, how far does this domination of the stock market go? Where is the top? Do the Mag 7s, do they go to 50? Do they go to 60%, 70, 80 of the whole total market value, just 7 stocks? And then you got the Goldman Sachs speculative trading indicator. It's now at levels nearing where the dot-com crash was. It's even higher than the 2008 financial crisis. So these are the indicators, they're warnings. I mean, these are things we watch. But really, we're trend followers, so we really watch the actual trend. And again, another thing we got to keep our eye on, August and September are the weakest months for the S&P 500. So here we are in August, the first day of August. We've had a very big correction happening on this day. So we're starting to see, some different things happening. So like I said, we're technical. We watch the trend lines. When they're breached, we sit up and take notice, and we let our subscribers know what's happening. Well, we just had a trend line broken. And this morning I just sent out a partial sell signal to our subscribers, and where we just sold a quarter of our position in the S&P 500 for a nice gain, about 213%. But that's really key for all your listeners. I mean, if you've been riding this uptrend and you made some really good gains, you don't have those gains until you book some of them. And that doesn't mean you have to, you don't have to book it all. But smart investing means not just riding the winners, but you got to lock in gains along the way. And so that's what we've just done. We just took a quarter of our position. We banked a 200 and some odd percent gain. We're still in the game, but we've turned those paper gains into realized returns. So if this pullback in the market continues, I suspect it will be fairly short. The S&P is currently at what are we at here? 62.40. So again, it's down about $100 for the day. Near-term support is 61.50. One of the things we're watching out for is, a black swan event could be the Russian response to Trump's threats.
President Trump has taken a notably tougher stance, with Russian President Putin issuing a much shorter deadline to negotiate a peace deal with Ukraine. How do you see that playing out?
Yeah, it worries me. It makes me wonder if Trump hasn't totally miscalculated Putin here. He ran on a platform of anti-war and, claiming he could get peace in Ukraine within a day. And he hasn't made any progress in that. He's been here, almost 6 months, I guess? So, no, 6 months, more than that. So I think he's more worried about his ego here, it seems. But one thing I find really interesting is that right after announcing the trade deal with the EU, Trump intensifies his ultimatum to Putin. Now, we know that Russia is one of, or if not, the richest country based on natural resources. We also know that there's many of the EU bureaucracy that they think that it's time to take Russia down and get access to those resources. And I'm wondering, did Trump give that ultimatum to Putin just to appease the EU so he could brag about this new trade deal? The thing that worries me is you got ultimatums that corners Putin. That leaves him with little room to save face, and that could provoke a defiant response. And for those who think that, if we could just remove Putin, Russia would cave and then we're all good, I would say, be really careful what you wish for, because there are many more hardliners in Russia than Putin, and a lot of them don't like the way he was even negotiating. So I think Trump is poking the bear here, and he's risking escalating this war. Now, in response to Trump's, raising that ultimatum, former Russian President Dmitry Medvedev, his response was, I got this right here, said, each new ultimatum is a threat and a step towards war, not between Russia and Ukraine, but with Trump's own country. And then, of course, Trump fires back in his typical name-calling style, calling Medvedev, the failed Russian president, and warning him to watch his words and telling him he's entering dangerous territory. When you hear this, this is how wars escalate, when you get these heads of states acting like 12-year-old boys name-calling at a playground. And I just hope there's somebody out there that can calm things down and get peace agreement and end all this senseless killing. We used to have a Prime Minister, Lester Pearson, and he was the kind of guy that could do that. And I don't see who in the world right now is going to step up and calm things down.
With currencies, last month you said the U.S. dollar was oversold and you were calling for it to rally. Since then, the U.S. dollar's up over 3%. Why?
We talked about this last month. So the U.S. dollar, the world reserve currency, and it had that huge 12% decline from January to when we were talking in early July. And the reason for that decline, or a big piece of that reason, was due to the trade wars. We'd been seeing all of this, everybody was pissed off at Trump and the U.S. And so there was this building, sell America theme, where many large, foreign pension funds and large foreign institutions, they started selling U.S. assets looking to support more of the domestic ones. So that meant, the process is if they sell the assets in the U.S., well, now they have all these U.S. dollars, so they convert the dollars back to their local currency, and that just simply, they're selling the U.S. dollar, and that pushes the dollar lower. We also had, the big spending bill, that got passed. That increased the U.S. borrowing cost by another $700 billion. And that's according to the CBO office. They also said it was going to add $5 trillion to the U.S. debt over the next decade. So the decline in the U.S. dollar, it was front page news. Everybody knew about it. Everybody was bearish. And when you get everybody on one side of the boat tips over. And that's what we've been seeing. We had record number of retail investors who were heavily short the U.S. dollar, and they were short on margin. So you had many retail investors, they were trading at 100 to 1 and some up to 500 to 1 leverage. So here we are, as you say, the U.S. dollar started to rally. Well, these guys are caught short. And as the dollar was rallying, they're heavily leveraged. So now they've got to cover their bets. And to do that, they need to buy a U.S. dollar. It got so crazy. I think actually I mentioned this last month. I was reading tweets that the U.S. dollar was dead and it was going to crash 40-50%. Well, when you get that kind of crazy sentiment, something's going to change, that the sentiment's way too heavy on one direction. And the pendulum always swings back the other way. So one of the other reasons we saw the U.S. dollar rise last week is we saw their GDP data was higher. So that means their economy was up 3% versus the expected 2.6. Now, the previous key support level for the U.S. dollar was 100, and it fell through that. So that 100 is now key resistance. Now, the thing I'm really watching is the 200-day moving average is just over 103, and I think that we could see that tested. And if we get to 103, that would be a retracement of over 50% of that 12% decline since January. And if all of this happens, then we're going to see things priced in the U.S. dollar sell off. So, that means commodities, that means, precious metals potentially. So you got to keep an eye on that. Everything's connected here. So the U.S. dollar is down today. So right now it's, what do we got here? 99.03. And now that's with the week job data that just came out. So now, we had the GDP go up earlier in the week, so everybody thought, okay. And now all of a sudden we're going, oh, wait a minute, the job data is down, so is the economy slowing down? And that would, if the economy were to slow down, that would increase the odds of a Fed rate cut, and that would mean that the bond rates go down, and that would theoretically push the U.S. dollar down. But one of the things that really, I think that the mainstream media really misses, and what most people don't hear, is that they love to focus on how the U.S. dollar is going to continue to weaken due to the ever-growing U.S. debt, and that is true. But they seem to forget that all paper currencies lose purchasing power basically at the same rate. So, yes, the U.S. dollar is going to lose purchasing power, but it's really what's happening between those currencies. They're all losers. It's really, which one's the least ugly house on the street, right? So they're all losing their purchasing power. The Canadian dollar, the euro, the pound, the yen, and the U.S. dollar. The real question is which one will be stronger amongst the group. So longer term, this is something else we should talk about. I'm expecting to see U.S. dollar rise with the new Genius and Clarity legislation, all related to stablecoins, and we could chat about that a bit later.
What's your take on gold, silver, and platinum, palladium?
Well, to start with gold, it hit that all-time high in April, 3,500. And then since then, though, it basically done nothing. It just kind of meandered sideways for the last couple of months. And that was worrisome. I mean, one of the things we were highlighting is that, gold really did nothing. And during that time, the U.S. dollar had been plunging. The U.S. dollar decline, we just talked about it, was front page news. Everybody knew about it. And yet it dropped 12% since January, and it dropped 8% since gold hit that 3,500. And so 8% drop in the U.S. dollar, and gold's at 3,500, and yet gold could not move. So then currently, if we move to today, we've got the Fed did not cut rates on, Wednesday, I guess. So that put pressure on gold. So I think we could see gold drop, 15, 20%, which would be a buying opportunity, something for your listeners to think about. And like I said, I do think that U.S. dollar certainly could push towards that 103 level. And I think that would put pressure on all those precious metals, gold, silver, platinum, and palladium. Now, the point of control for gold is 33.45, and point of control, for those who are not aware of it, I mean, that's where the highest amount of trading happened for a period, and here we're talking about 30 days. So it often acts as a key support or key resistance level. Now, given that gold dropped below the POC, suggests that the momentum now is to lower prices. And that makes sense, especially, like I said, if we see the U.S. dollar rally up to like 103. So today, we've got the trade war uncertainty back on the front page, and we saw gold has jumps up. What are we at here? Up about $50. So it's trading right now at 33.50. So that's right at its point of control. So for those who are wanting to add to their gold position, or to those who missed on this great, 2-year run, I think you're going to have a better buying opportunity. I'm thinking, looking short term, I'm looking for a pullback in gold, but at longer term, I'm really still very bullish. I mean, you look on the bullish side, you've got Trump's big spending bill. It's going to add $5 trillion to the U.S. debt. That could give gold a boost, because obviously that's going to eat away at the purchasing power of the currency. If Trump does get Fed to cut rates, that's certainly going to help gold. Of course, we've got the central banks buying gold to protect against currency drops, global uncertainty. And then, of course, you've got governments everywhere spending way more than they bring in. So that's piling up massive debts and deficits. And that makes gold more appealing as a safe haven, to hold value and, again, protect that purchasing power. So here I say right now on Friday, gold's up about $50. Trading near its point of control at 33.45. Near-term support would be 32.80. Near-term resistance would be 3400. Like I say, Jim, I'm very bullish gold long-term. Short-term, I'm looking for a bit of a pullback. Now if we look at silver, you're pretty much the same story. Silver hit just under $40, but now it's pulled back almost 10%. It's at 36.80. The 35 level should offer some good support. And I mean, if it closed there, that would be about a 12% pullback for silver. And then palladium, it had that huge run in April, up about 70%, set a new intraday high at 14.45, I think it was. But in the last week or so, platinum has dropped about 15%. And again, if the U.S. dollar keeps rising, then we're going to see, I think, all these precious metals get challenged. But again, as investors, pullbacks are important and they're healthy, plus they give us better buying opportunity. So big picture, precious metals, they provide protection against loss of purchasing power with massive government debts and deficits. So let's watch, see if we get a pullback in them. And if we do, like I say, all of those should pull back. And again, that would give you a nice buying opportunity.
What's happening with critical metals and minerals?
Well, for most of the people, so critical minerals and metals, materials, I mean, those are your natural resources, right? They're essential to the modern technologies, to national security, And the real risk here is that they have a real risk of supply disruption. And they're very critical for manufacturing, clean energy. So, all your EV batteries, solar panels, wind turbines, they're needed for electronics, and especially for, defense systems and advanced industrial processing. So the examples, kind of some of the ones that are there that are considered critical, you got, lithium for batteries, you got cobalt for batteries, aerospace, you got rare earth elements, so those are for magnets and electronics, nickel, graphite, copper, platinum. So now the thing with these is that many of these are concentrated in very few countries. And so that makes the supply chains very vulnerable, and that's a big part of what makes them critical. And what's happening now is you got countries like the U.S. and Canada finally waking up that these materials are needed, and they need to be developed locally and not to rely on countries like China. So for years, due to very strict permitting and other regulations, in Canada, in North America, investors basically gave this sector up for dead. They didn't want to deal with it anymore. Governments were just too many roadblocks. So now we've got governments that are having to help bolster the whole sector. Now in the U.S., just a few weeks ago, we saw something very interesting. We saw the Pentagon. They made a $400 million direct equity investment into a company called MP Materials Corp. And that company is the only rare earth mining company in the U.S. And so the Pentagon became the largest shareholder, owning about 15% ownership. Now, luckily for our subscribers, we actually own that company inside an ETF that we recommended a month or so ago. So now the fact is that the U.S. government is stepping in here, and they are helping to bolster an industry, a sector that other investors have just left for dead. And it really, this sounds like socialism, but it's, the governments basically, they caused the problem by restricting the development so much, and now they're having to come in and help rescue it. So it's very interesting what's happening. It's almost like the U.S. now is following China's lead in directing and supporting a market that was not profitable without them. So they need these materials for social or national security. So they need to help bolster it. This is about as non-capitalist as you can get in the approach. But I think we're going to see more and more of this model where governments have to come in and help kind of correct areas where they've kind of killed that sector. So now my fear is you get in a country like Canada, man, I just hope the government doesn't come in and try and take over the sector, because that would be a disaster. So I think it's going to be very interesting as we go forward. We've got all the NATO countries now saying that they're going to commit 5% of their GDP on defense. You think about that. They couldn't even do 2%. Now they're going to over double their spending, and they need a lot of these critical minerals and materials. So I think it's going to be very interesting. We are involved. We have a position in there. We're certainly looking around for some more. We're tracking this real close.
What about energy?
Well, energy, if you're looking at oil, that popped earlier this week after Trump announced the trade deal with the EU. That created optimism for, that barrier's been removed, global growth. And then, of course, he shortened his ultimatum to increase sanction on Russian oil. So that gave oil another boost. If you're going to restrict Russian oil, theoretically, that would reduce the supply. So that bumped oil up to just over $70. But that only lasted a day. Now here we are today. Trump's raising tariffs on dozens of countries, Canada included, got the weak job data in the U.S., and so all of that gain's been pulled off. So right now today, oil is down about $2 here. Now I've been saying for the last while, if it was just about supply and demand and not geopolitical stuff, I think oil would be lower today and much lower. I think sub $60. The facts are you got declining demand in China. You got the soft economic data in the U.S. and in Europe and Canada. And you got supply. I mean, supply is not excessive, but it's still on the high side. And based on seasonality, from June to September, that is a weak period for oil. So oil today is at 67.14. Now, if we get more tensions with the U.S. and Russia, I mean, we could see it back up to over 70. And if that, if the U.S. Russia really starts escalating, we could see oil spike certainly $80, $90 if Russia starts pushing back. But if these geopolitical tensions calm, then I'm looking for a drop below $60, especially if we see, that rally in the U.S. dollar we were talking about earlier. But fourth quarter, we should see oil start to move up. And then if we look at uranium, one of our other favorite energy plays, we've seen the Trump administration make a number of announcements about nuclear energy recently. In May, he signed that executive order to reduce regulations that, plants now have to be licensed within 18 months after applying for permitting. That used to take years, up to 5 years. Expansion of uranium mining and enrichment is to be done in the U.S. You have Westinghouse has agreed to build 10 large nuclear reactors in the U.S. And then if we look at uranium, just a couple of weeks ago, we had what's his energy secretary, I think it is, Chris Wright. He proclaimed the U.S. was launching a nuclear renaissance. And so we got things happening in nuclear in the U.S. But this could be incredibly bullish for Canada because Canada has some of the biggest uranium deposits in the world. So we got the U.S.-Canada trade agreement happening. So I'd be really loving to be a fly on the wall on that because I would hope Canada's using uranium and critical minerals. That should be a very hot talking point, I would think. So there's still lots of hurdles in the whole nuclear world. They're talking small nuclear reactors. That's great. Sounds good. But they haven't figured out how to dispose of the spent fuel. Costs for any plant are very expensive. They're always way over budget. Now, if we're looking just at uranium, closed recently at 71.25. Now, that's about 10% lower than the rally that topped about a 7-month high at about $79 last month. But it's still up $10 from the March low. Jim, we are big time bullish uranium long term. Uranium gets volatile. So if you see a big pullback, that's the time that you want to be looking to add to your positions. What's the latest with Bitcoin? Well, Bitcoin's been, it's been quite solid during the whole tariff uncertainty. But I've mentioned before that Bitcoin has actually been trading much more like, a high tech stock, more, like the NASDAQ, than it has like gold as a safe haven play. I think that's going to change, but right now we've seen that, like I say, it's done quite well recently. It got a bit of a kick from the U.S. with that Genius and Clarity Act legislation. But right now, I'm seeing Bitcoin has been consolidating. It's been trading between, about 115,000 and 120,000. Today it's down about 2,500. So it's actually dropped below that 115,000 support. That's been in place since early July. So it's, like I say, it's been acting much more like the NASDAQ than gold. The next support for Bitcoin is about 112,000. Now, there's a solid resistance line. I think I may have mentioned this last time I was on, that runs from the high in 2017 up to today. It tested that high in April and October of 2021. Then it tested it again in December of 2024 and again in January 2025. And it tested it just a week ago again. So that's 6 times that this resistance has been tested. And so far, Bitcoin has not been able to break through it. Now, I think it's going to, but I think we're going to have to see a pullback here. If we see a pullback in the stock market, I think we're going to see a pullback in Bitcoin. Bigger picture, though, I see Bitcoin becoming much more of a safe haven play like gold. We've got China wrapping up stimulus. We got U.S. with their big spending bill. We got Canada, Europe, all these countries committing to, these massive stimulus spending programs. And the end result of all of that is all of those fiat currencies are losing more and more of their purchasing power. And, that's just bullish for precious metals and crypto.
Last month, you highlighted some stocks that were creating digital asset treasuries, and this was a key to the big jump in Ethereum. You highlighted one called Bitmine Immersion.
Right. So what we got there is that I think so what we talked about is that, how Ethereum jumped up, 60%. And it was after Trump signed the Genius Law and Act into law. And that also, how they were planning to pass the Clarity Act. And as we discussed, this is all related to stable coins and how stable coins are usually backed by something like the U.S. dollar or U.S. treasuries. But we were also starting to see these new companies creating what they call themselves, digital asset treasuries. And what we walked through that whole process. So I don't need to do the whole thing again, I don't think. But similar to what they're doing is similar to what MicroStrategy did with Bitcoin. So what they do is they buy the underlying crypto and they hold it like a treasury. And what this did is this gave Ethereum, because these companies are saying that they are going to be Ethereum digital asset treasuries. And so that gave Ethereum that big spike. But the big key, what we talked about last month, was that company like Bitmine, where it soared 3,300% in less than 5 days. And as I warned back last month, that type of kind of movement, it's insane. And sure enough, just after that, within a couple of weeks after that, it gave back 76% of those gains. Now, it's still up 500%, but if you got in near the top, you're down big time right now. And I think that's what happened to most people. I mean, the ones that got in early, they did great. They made 3,300%. They sold off to the latecomers, and those ones were holding it all the way back down, and they're down about 75%. But it does show you how volatile those stocks are. And the thing what I think I mentioned last month is I think we're going to see a lot more of these copycat stocks, right? They all want to jump in on this bandwagon. But I mean, if you think about it, it's really, your asset, the net asset value of these things, you're paying $2 for basically $1 worth of asset. And that doesn't make a lot of sense to me. So to me, if you want to get involved in this play, the underlying winner in that was Ethereum. So if you want to get involved in that kind of play and you don't have the stomach for the kind of volatility like Bitmine, you can simply buy Ethereum. Or if you don't even want to go that route, you can buy one of its ETFs. You can buy the iShares, which is kind of matches the Ethereum movement. So that's ETHA. Or if you want some leverage, you could use like the ProShare 2 times Ethereum, and that's ETHT. So yeah, there's always ways to play this stuff. If you're a real speculator and you're willing to spend money that you're gambling with, if you want to try and jump on one of these companies, have to, fill your boots. But if you're a little bit more cautious, there are other ways to play this.
You posted an article on stable coins and how the U.S. Treasury is using them to help support the U.S. debt and U.S. dollar. Can you elaborate?
Yeah, we're getting a lot of feedback from that article. So it's not, from the questions I'm getting with it, a lot of people, it's just, it's so new. This stuff is so new. It's hard for people to kind of grasp. The article, I think, certainly helped people understand it. But it's not, for the average person, when you talk about, stable coins going to help fund the U.S. debt, it's like, what are you talking about? And so it's just not obvious at first glance for most people how crypto could possibly help U.S. fund its debt. But let me try and explain it. So stable coins, unlike Bitcoin or, Ethereum or any one of these other kind of quite volatile coins, the new law that they signed in, so that, the Genius Law and the Clarity Act, those basically what they're doing is they want to stabilize these things. So what they're saying is that it has to be backed by a stable asset, and particularly by the U.S. dollar or U.S. treasuries. Now, you could argue that the U.S. dollar isn't stable or U.S. treasuries aren't stable, but compared to how some of these cryptocurrencies bounce around, they're considered stable. So every time someone creates or mints a new stable coin, the issuer has to then go out and buy a matching amount of U.S. government debt. So, so short-term treasuries, for example. So as the demand for stable coins grows, these issuers then become automatic recurring buyers of U.S. debt. And think of it just like foreign governments or big banks used to be. And like I say, now that we've got the Genius and Clarity Act, that gives stablecoin issuers this clear legal framework for growth. So that, so now there's some rules and it's fairly clear how this has to work. So what I got is the U.S. government is not just tolerating stablecoins. It's encouraging them because it creates a new private sector buyer for their treasuries at a time when we're seeing foreign demand, especially China, that demand is shrinking. So, maybe think of it like this. So, let's see here. Say the government borrows money to buy, when the government borrows money, they have to sell treasuries. Well, somebody has to buy those treasuries because for a government, the day that nobody will buy your treasuries, that's when you start to go into default. So what they've done here, I think is quite brilliant. What they've done here is they've created this whole new market to support the treasuries. So stable coins, they raise demand for the treasuries. And so people that are buying stable coins and then you have the next layer of that where they're buying other cryptos and other transactions, they're not necessarily thinking, oh, gee, I'm buying U.S. treasuries. But those stable coins, that original stable coin is now backed by the U.S. Treasury and U.S. dollars. So that's the key. It's kind of an underlying, it's behind the scenes scenario. So the upfront buyer of whatever he wants to transact probably doesn't even care about the treasuries, but the U.S. government certainly does. So they've created this new environment where the stable coins now have to be backed by treasuries. That creates new demand for treasuries. That keeps the interest rates from rising too fast, and it supports the dollar's global role. So that, global reserve currency. So it's a win-win game. You've got crypto gains legitimacy and real-world use, and the U.S. government, they get to tap into this new channel to fund their massive deficits and debts and to strengthen the global demand for the dollar and treasuries. I know this stuff is new, and it's one of the reasons that we published the Trend Disruptors and why we've issued our new DeFi Digest. Because our goal is to help investors understand how these new developments in the financial sector are going to dramatically change how we conduct financial transactions. So even if you don't think you want to know, I think you might want to start looking at this stuff. And we try to explain it in pretty simple terms. So, think about jumping in on that to at least have a look at it.
Martin, you're a very, very busy person. You're now running 6 services, 3 premium and 3 for free. Your premium services, Trend Letter, Technical Trader, Trend Disruptors. You can get these ones for free, DeFi Digest, Market Pulse, and Headlines. Can you give us a quick overview of each one? And I also think you've got some summer discounts on the premium services as well.
Yeah, we do. And it's not just me. So, yeah, I'd be going crazy if it was all just me. But, yeah, we've extended. I mean, we try and react to what our subscribers say, can you give me some information on this? And we've been in we were in Bitcoin very early on, and we did that same kind of thing with our disruptor service, explaining to people how to use digital wallets and how to do these different things. But more importantly, what's coming. So, just to walk through all these services real quickly. Trend Letter is, these are the first ones are paid services. 24th year of doing it. It comes out every Sunday evening. The target there is for long-term investors who want to understand what's driving these markets. The price is regularly $600 per year, but we do have some discounts, and I'll tell you about those in a sec. Trend Letter covers all sectors, so equities, currencies, precious metals, commodities, and bonds. And really what we do there is show people how it's all connected. And I we get so much feedback. People go, well, I'm only interested in gold, or I'm only interested in this. And I just say, if you don't understand the influence the U.S. dollar has on all these other sectors, if you don't understand the connection between these various sectors, you're going to have a tough time really being able to get in and out of the market and make some good money. The second one is Technical Trader, online service, updated, 3 or 4 times a week, both active and long-term investors. It was originally a hedging service, but it also now does long positions, so it does both. And it includes our proprietary gold technical indicator. Its regular price is $650 a year. I'll tell you again about how you can get that much cheaper. Trend disruptors, that's for speculators with risk capital. So this service invests in disruptive ideas, AI technology, virtual reality, augmented, 5G, cloud, all that kind of stuff. $600 per year. Now, the free ones, DeFi Digest, like I say, that's documenting developments in that whole sector. I know we've talked about it, gone over it a few times. Very quickly, it leverages, DeFi leverages blockchain technology to deliver financial services, and here's the key, without traditional intermediaries like banks. That's the key. If you throw something against the wall, if that's all you remember about DeFi as a starting point, that's a really good place to start. Put it into context, to me, it's very much like getting in the ground floor of a financial revolution, very similar to what we saw happen with Bitcoin, over a decade ago. Again, it's a peer-to-peer financial ecosystem, and it's built on blockchain technology. So that means it's open to anyone with an internet connection. And again, no paperwork, no middleman, no banking fees, etc. So, and again, we've talked about this before. The largest banks in the world, JP Morgan, BlackRock, they have forecast that in the next decade, we're going to see between $15 and $30 trillion market for real world assets. So think about that. I mean, that's a huge thing. And so what is that? What does that even mean? People will say, well, you're talking about a huge range of assets, from corporate and government debt, real estate, commodities, fine art, buildings, houses, you name it. And there's even racehorses done. And it includes, fractionalization and tokenization. And I know people will gloss over when they hear these terms, but we explain all this stuff. So, DeFi Digest will really help you start to understand this stuff. And again, to me, early adopters are going to have an opportunity to capitalize on a shift similar to what we saw when we saw the internet boom and we saw the whole Bitcoin crypto boom. And again, the big key to me is people need to understand that there will be a learning curve, just like with Bitcoin in those early days. And the DeFi Digest, what they do is you want to be able to master things like digital wallets, private keys, smart contracts. And again, DeFi Digest explains all that stuff, and we're going to help educate people to work your way through it. So the learning curve is going to be there. But if you're a listener out there and you're interested, you'd like to explore new technology, this isn't some fly-by-night thing. $15 to $30 trillion is massive. And I think that people are just going to be blown away how fast this comes into fruition. The other two ones we got that are free, the Market Pulse, what that is that's where we go out and we tell maybe during the week, or like, for example, we talked about how we saw the outside reversal. So we sent that out to subscribers. It's free, and we explain what happened there. We talked about the other day, we talked about how gold had dropped below its point of control. And we're just trying to educate people so they can understand how these interrelations between all these different sectors work. So again, Market Pulse is free. And then the other one we have is our headline service. And what we do there is we scour the market every morning, and we send out headlines that we feel all investors should be aware of. And so, a lot of these headlines, you're not going to see it on the front page of most, mainstream media. But we're picking out things that we think are going to impact investments coming up soon. All right. And so readers can simply read the headline, and if they want details, they just click on the link. So if any of your listeners want any of those free ones, again, info@thetrendletter.com. Now for the specials, basically what we're giving you is minimum of 33% off any single service, and up to 57% off because you can buy bundles of the different services. So we'll send a link. Maybe Jim, I'll send you a link so that people can just go directly to that, or they can just go to our front page at thetrendletter.com, and you can click on the link there.
Martin, thank you so much for being on This Week in Money.
My pleasure, Jim. Enjoy the rest of your summer, and same to all your listeners.
My guest has been Martin Straith, founder of Trend News online at thetrendletter.com. He was speaking to us from Coquitlam, BC, which is just east of Vancouver. Coming up, Josef Schachter, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Josef Schachter, founder of the Schachter Energy Report online at SchachterEnergyReport.ca. He's speaking to us from Calgary. Josef, welcome back to This Week in Money.
Oh, it's a pleasure to be with you again, Jim.
What's new at the Schachter Energy Report, and how can our listeners subscribe?
Right now, we're working on, Q2, second quarter reports are out for many of the energy companies. We cover 37 from infrastructure to Canadian E&P or Canadian companies working internationally, service sector companies, so 37 in total. And we're working on that. Our first report with the first 9 or 10 will be out in a week or so. And then over the next 2 issues, we do 2 issues a month, we will cover all 37 companies so people can get a feel for how did the companies do, did they beat our numbers or were they less, what do we see as the good price to buy the stocks, what price do we think is a good target for 1 year, and given I'm bullish for the sector, looking for a multi-year bull market, where do I see the stock going in the long term? So people can go to our website, www.Schachter, SCHACHTER, energyreport.ca, and there's a subscriber opportunity. Either you can buy a quarterly subscription or an annual subscription, and you're also going to get included 2 tickets to our conference in Calgary, which is called the Catch the Energy Conference, and we do it at MRU. It'll be Saturday, October the 18th this year, and we have potentially 40 companies coming, everything from small companies with 2,000 BOEs a day to a company over 600,000, which would be Tourmaline. So we do have a nice mix of companies coming, and the TMX, which is the major sponsor, also has room for critical minerals, clean tech, and renewables. So we have a real nice, interesting energy industry of today and energy industry of tomorrow opportunity. And, for individual investors who might own, Tourmaline, Birchcliff, Bonterra, a STEP or whatever, to go and sit and talk to the management of the companies you own is very difficult now. AGMs are all, virtual. So to have time to go up to the booth, hear the presentation earlier, then go to the booth and talk one-on-one with the companies you own or companies you're interested in own, it's really the only opportunity for a conference like this in Canada. And we've been doing this since 2018, except for the COVID years. And every year it just gets better and better. And we're in the process of signing up companies still. But we've got ourselves a pretty nice lineup at this point.
Mm-hmm. How can our listeners attend the event?
Well, they can either buy direct tickets, which again would be on the website, or go to catchtheenergy.com, or go to and become subscribers to the Schachter Energy Report, and you'll get 2 complimentary tickets, which either you can use yourselves, this new subscriber, or they can give it to friends and family who they know can come into Calgary for the event. So, you're talking, almost a $300 value there, and it's definitely worth coming. And every year just gets bigger and better, and the reputation is there, and people can just go to the website, and there's a video that TMX did so people can get a feel for it and look at the list of companies on our Ion Energy, which we do the weekly report, which is now on Substack. You can go there, Ion Energy or Joseph's Ion Energy, and then you can see the companies that are signed up already, and we're in the process of signing up some more. So every week we'll be updating the list of companies that are coming, but it's getting to be a nice full list, and we're working a way to make sure we have a complete list between now and mid-September.
President Trump just made a deal with the unelected European Union that includes the EU purchasing $750 billion of energy from the U.S. What are your thoughts on that deal?
Well, number one, the EU, I agree with you, is unelected, so they're going to push this down on their countries. But last year, the U.S. sent a lot of LNG, and also they export light oil because the Texas production can't go into the refineries in the Gulf Coast because they've been built to handle the heavier crudes from Mexico, Venezuela, and Canada. And of course, Venezuela is not selling into the States anymore, so it's Canada that's 60% of what they import. Last week, the imports was 3.4 million barrels, of which the majority was from Canada. So going back to Europe, under 100 million was what they bought of LNG crude and crude products. So to do 750 billion over 3 years doesn't make any sense. Number one, Europe probably can't handle taking that much. Number two, they don't need it. And probably the most important part, number three, the U.S. can't supply it. The U.S. Can't build LNG plants tomorrow. If you announce the new LNG project today, it probably wouldn't be ready in 3 years. The U.S. oil and gas industry, the oil side of it, is flat production right now, 13.3 million barrels, and it's flat on last year. A year ago was 13.3, so it's only up 14,000 barrels from a year ago, according to the last EIA report that I have in front of me. And so, this price where $69 for WTI is not an incentive enough for companies to do more drilling. They're going to need $80 plus US $80 WTI or more for them to be incentivized to spend more money. Trump's drill, baby, drill just does not work if the economics don't work, and at $69 they do not work.
Crude oil supply and demand versus investor optimism. What are you seeing ahead for crude?
Well, it's a seasonal thing. So, last week, for example, the EIA report that came out on Wednesday showed that the commercial stocks rose 7.7 million barrels from 419 to 426.7. So building of inventories during the summer doesn't normally happen, which tells me that demand is a little bit weak. And one of the things that's interesting is exports fell from 3.85 a week ago to 2.69, down 1.2 million barrels. So a lot of countries around the world may be saying, okay, look, until we have this tariff decision made with the states, let's hold off buying American crude. And then when we get a deal, we can, start buying more from that point and then say, hey, we're meeting our goal of buying American crude. So to me, the demand right now, summertime is high, maybe 105 or so, 104, 105. It'll back off in the fall. So that's where you might see supply exceeding demand, and that's why I think the price of oil could back off into the low 60s. And if it's very, very weak numbers below $60, maybe touching the lows of April, $56 to $59 a barrel, but that'll be for a short-term period. But in 2026, I think because of the lack of spend by the oil companies, as I showed you, they mentioned 13.3 million is not up from a year ago. We may see depletion kick in, where the amount of production is less in 2026 at the beginning of the year. So we may then see higher prices come, and then of course companies will react if the price is high enough. but it'll take them time to bring on that new oil. So my guess is we're going to look at $75, $80 in 2026. If that's the case, then from the upcoming lows for oil, which as I mentioned, below in the low 60s to maybe below that, that could be the next great buying opportunity. You remember in April, I said it's a table pounding buy when we were in the mid 50s, 56, 57, if you remember, and we put out a lot of new buy recommendations on individual stocks. My guess is sometime in September, October, we're going to have another low risk entry point, and people should be building up their buy list, waiting for the buy signal, and we send that out to people via an action alert, and so people can, depending upon their risk profile, size, dividend yield requirements, they can find names on our list, find which coverage list, see which ones fit their portfolio needs, and then when the time is right, they'd be able to buy and add to positions or build new positions. So we provide all that information in our research, and it's worked out quite well.
President Trump has set August 8th as a deadline for an end to the Russia-Ukraine war. Could the price of crude be affected depending on the outcome of August 8th?
Correct. Yeah, I believe what he's threatening is sanctions not only on Russia, but tertiary sanctions on China and India for buying Russian oil. They also on the crude, the ships, on the insurance, on the banking, all of those things, they can increase the pressure to mean that less revenue comes in for the war effort that they have, which is enormous percentage of their economy is devoted to the war in Ukraine, and paying for drones, paying for the soldiers, paying for the veterans, paying for the wounded, paying for the deaths in the front lines, paying the North Koreans for being there to help Russia at the front lines in eastern Ukraine. So there's a massive cost structure there, and so if the United States can cut off their revenues, maybe they'll come and say, okay, we're not winning this war, let's find a way to get a peace agreement that we can live with, and that Ukraine can then survive and thrive. One of the issues, of course, will be Ukraine wants to become part of the EU and also part of NATO. I think Russia might be willing to accept them becoming part of the EU, but I do not believe they'd want them to be part of NATO because they already have troops in the Baltic from foreign countries right on their border. They have them in Poland, and I don't think they would, and then Romania. I don't think they'd like to have foreign troops on the soil of Ukraine. They've been attacked more times. Like Russia has not attacked Europe, except in World War II to defeat the Germans, not the Nazis. But, the French have gone after them, the Tatars have gone after them, the Germans have gone after them. So they have a mentality of how do we keep ourselves safe with all these invaders coming. So my view is that something is going to have to be done to make Russia comfortable that they will not be invaded. You already hear some of the Baltic state leaders saying Russia's too big, we should break it up. There's talking about drafts in Europe. So there's more of a war drums going on. And so, it may be to entice Russia to the table to negotiate and get a ceasefire and a peace agreement. But on the other hand, Europe is moving more because their economies are stagnating. And when times are bad, wars are good for political leaders and also for their economies because they spend more money on defense, 2% of GDP to 5% of GDP that Trump's been asking for. But to me, the more money you spend on defense and you start drafting and training more soldiers, the bad thing is sometimes you use them, which would be awful, and that would make continental Europe into World War III.
President Trump says the U.S. will be self-sufficient in crude and natural gas. Could a lack of exports to the U.S. affect the BRICS nations, and is OPEC losing its power?
Let's start with the U.S. The U.S. last week, between domestic crude production, 13.3 million, and natural gas liquids, condensate and propane, etc., 9.8. All that together is 23.1 million. They consumed last week 21.4. So the U.S. is very self-sufficient. It's just a question of what goes into refineries. That's why they import heavy from us and sell the light oil from, the Eagle Ford and Permian to foreign countries that have not as sophisticated refineries. So the U.S. is self-sufficient. They could probably, with the right pricing and right regime for drilling, like removing all the regulations that Biden put in, allowing more drilling on American onshore and offshore lands that are federally owned, opening up Alaska for more drilling, which they're going to do, also allow LNG exports from Alaska's southern ports to Asia, Japan particularly. So I think there's going to be a lot more exports in the years ahead. The U.S. basin is still very, very attractive. Exxon's one of the biggest players there. They're talking about maybe adding another 1 million barrels to the 2, I believe, that they're now, just in the Texas area, Permian and Eagle Ford, et cetera. So I think that there's still lots of growth, new technology, better completion techniques. The well performances have been better. So I think that that's a positive. In terms of the BRICS, Brazil is an exporter, Russia's an exporter, India and China are both importers. So I think that we're probably going to see, the India and China have to make a decision. Are they going to want to push a settlement so that in Ukraine, so that they will continue to be able to buy oil at a discounted price from Russia, or will they have to go on the open market and pay much higher prices, which would drive prices up? And of course, Russian production would be stagnant and would be locked into the country. In terms of OPEC, OPEC kept on saying that they were going to, increase production at very high rates, 411,000. They were only able to do 180 to 220 in the last 2 months. So they do not have the productive capacity to really increase. So right now, with global supply and global demand, right now with more supply than demand, and that doesn't change until winter 2025, 2026. They really don't have the power to dictate. And right now they're fighting for market share, which means that would be higher, not higher prices, but probably somewhat lower prices in the coming weeks and months until winter comes. Once we get into November, December, it's the weather clock. If we have a cold winter, prices go much higher. If we have a normal winter, they'll still go higher. If we have a moderate winter, then they may stay around the price where we are now.
President Trump is seeing some success in stopping wars and making trade deals one by one. Is this having an effect on the price of crude?
Well, we saw the Pakistan-India thing settle down. Thailand, Cambodia recently. Again, he threatened trade issues with them, so they had to, for their own financial interests, had to come to the table and stop fighting. We sure don't see Hamas and Israel solving their problem. So that war is still nasty, and it's a question of Hamas giving up power and letting the Palestinian people have a life without war. You saw the thing that Canada today is planning to vote in favor of a Palestinian state. So there's a lot of political movements going on here to help the Palestinian people, but in terms of Palestine as an oil producer, they're not. So they really don't have any power economically from type of products that they would sell outside of maybe agricultural goods. And again, with a war zone, not much of that happening. So oil is really not being affected by those geopolitical events. I think Russia's one of the ones to keep an eye on. If Russia doesn't do anything by August the 8th, is the line in the sand by Trump a non-issue? Remember, we kept on seeing with Obama and Biden lines in the sand. Nothing happened, and nothing happened afterwards. So America did nothing. So is Trump just using his political seat to scream and vent on this issue and not pull any triggers afterwards? That's something we'll find out. The other one to keep an eye on is China. They're stretching their military adventurism. They've been having warships near Alaska. They've had a lot of flyovers and ships around Taiwan. Taiwan could be a powder keg if they. Some people in the geopolitical world are saying that they could do a blockade of Taiwan. If they did such a thing, that would be enormously difficult for the world because, number one, the Straits of Malacca is where a lot of oil gets through, and as we know, NVIDIA uses Taiwan Semiconductor to build their expensive semiconductor chips. And if a blockade happened, China could say no ships in and out, no planes in and out, and cut the world off from all those chips. So all the AI spending that Microsoft and Meta are talking about spending, ain't going to happen. So I put that one on the watch list. And as you know, you've had Martin Armstrong on. Martin thinking we're in a war cycle. There's a number of people who think that's the case. All the things you see about going on in Europe with increased military spending, which has helped the defense stocks in there and in South Korea. And then you add on top of that military hiring and training and bringing more troops on, and then talking about drafts. All of that is, is banging the drums, and all of that. If it gets out of hand and somebody makes a mistake, we could see the first shot fired. If you remember, the assassination of the Archduke in World War I, and turned it into a global war.
What's the latest on rig data?
Well, the rig data is sloppy and down because the price of oil is not very good. So, for example, the U.S. had 542 rigs last week, down from 589 a year ago, down 8%. When you break it into the mix, gas is up 122 versus 101 because of the LNG exports, but oil rig count is 415 versus 482, down 13.9%. Again, the price of oil is not attractive enough to spend money on drilling. In Canada, we're 182 rigs working last week, down from 211 a year ago, down 13.7%. And if you look at the mix for Canada, the rig count for gas is down 19.4 because of AECO being around $1, pretty horrible price. 54 rigs working versus 67 a year ago. And with oil, 128 working versus 144 a year ago, down 11.1%. So again, economics matter, and if the price is not high enough, why would you spend the money drilling if you don't have buyers willing to pay an economic price that you can make an adequate rate of return?
Could the stock markets be at a turning point here?
Yeah, I'm concerned that we might see a significant correction. We had a down day today, because of the I think the stocks in the tech sector had such a big run, and it was almost like Meta and Microsoft, drove the market higher at the opening, and then by the end of the day, all three indices, the Dow, the S&P 500, and the Nasdaq, all fell. The Dow's down 330 points to 44,131. If it breaks 43,000, I think we could see a break of 40 in September, and then we could maybe see mid-30s if things really get bad on the tariff side. And remember, the budget is still an issue, the trade budget deficits, the amount of bond offerings that the Americans have to sell, the battle now with Canada on trade, the battle with India, the battle with China. If anything goes wrong, like everybody said, they've got to deal with the EU, they got to deal with Britain, they've got to deal with Japan, but there's nothing in writing. There's no there's no contractual obligations, and all these numbers they're throwing up in the air, are just numbers. There's no commitments to do it, and and Trump's waving the flag, I won, but there's no commitment, legally for those numbers to be met. So As I said about Europe, with all the stuff they're going to buy energy-wise, they're not. Germany is not going to be buying American cars and most of Europe won't, because the streets can't take the big Ram trucks or the F-150s, which is the profitable vehicles. And America's EVs are nowhere near as good as China's, which are selling in Europe. So, a lot of the stuff is rhetoric, with no substance and no commitments. Would America be able to sell more energy? Yes. How much is nowhere near what they're talking about. Maybe they can sell more agricultural goods, soybeans and corn and wheat. But again, they're not going to be numbers that reach the numbers they're talking about. And, America, manufacturing goods, they're talking about Boeing selling more planes. Well, Boeing's struggling to meet the orders they've got. And if they put in an order today for a new, Boeing, 767 or 787, it might be 10 years before they'll be ready to deliver. So it really doesn't impact the United States immediately.
The Fed left interest rates unchanged this week. Could this lead to a fight between President Trump and the banksters?
Oh, well, that's on all the time. If you saw when he did the tour of the Federal Reserve building, it took Powell to say, look, one of the numbers you're including, like $500 million, was a building that was built 5 years ago. So whoever was giving Trump the numbers didn't give him numbers that were realistic. Yes, the cost of new buildings are there, but look how much Trump spent on the White House. You didn't have all that gold in the Oval Office as you have now, and of course he's doing more changes on the grounds, and to make it look like a Trump hotel. It's unbelievable, but the U.S. needs to refurbish buildings that were built 50, 60 years ago. And, you see that every once in a while when you look at the Capitol building, there's always, whatever they do for blocking when they're rebuilding and fixing the buildings, the exteriors. You see that all the time. And, the Federal Reserve building, Treasury buildings, they all need to be refurbished. It's like the issue do we do in Canada? The Prime Minister's residence empty because the building is infested and, the electrical doesn't work. There's asbestos in it, but the Canadian government doesn't want to spend the money. The Capital Committee doesn't say go. The reality is it should be a go because it's an important place for Canada to host international guests, and it's not being used properly.
This week, President Trump announced a 50% tariff on copper products, not the raw ore. Copper crashed 25% or 20% right away. Why do you think the price of copper crashed like that?
Well, the United States wants to do the upgrading and manufacturing of making pipe and coil and all those stuff. So what they want is, you send the basic, refined product to the United States, where it then gets bent and moved into products that can be used by industry. And so they want those jobs in the U.S., not the final product sent, dumped on the United States market. So they're trying to, just like they're doing with the steel industry, they're trying to keep those high-paying jobs in the U.S. So they're saying, okay, you can send us the raw material, into bars or whatever, the legal approvals that they're giving. And then once that's inside the United States, then the manufacturers, refiners in the United States will upgrade it and create the products that are needed, which means those high-paying jobs are in the States. And, the U.S. has, with the Marshall Plan after World War II, really allowed the world to come into the U.S. and do business. And it was advantageous to everybody. Japan recovered, Europe recovered. Well, the United States is the one now with trade deficits and budget deficits, and somebody needed to say this game can't continue. The United States can't be the, it's the military defender of the globe, but it also can't be the economic, sucker for the world. And so the tariffs are a way to realign trade and make it that the Americans have, some countries have where the Americans can't get in, but they want to export. For example, Japan on the auto industry, it was more all those auto plants were in Japan shipping. They did build plants in the southern part of the States, but the net was cars being shipped from Japan to the U.S. and U.S. not shipping to Japan. So this whole trade realignment won't come easy. It'll be painful. We're seeing it already in the steel industry in Hamilton and the areas there, the auto industry. You've seen announcements by most of the auto companies saying that they're taking big tariff hits in their second quarter reports, and they have to. You and I as consumers, we will find that when we go to buy a car, new or used, we're going to be seeing much higher prices. 15% tariff, on an $80,000 vehicle, and the auto, the cheap inventory that's there right now before the tariffs, that's the stuff that's being sold. Once that inventory goes, the new inventory is going to cost more, and that's the same thing with almost every other product. If it was low cost bought from China, 6 months ago, until all of that's used up in Walmart and all the other different retailers, we're not going to see the tariff impact, but we will see the tariff impact at some point before year end, and that's what I think the Fed is worried about, and why they're going to hold off until September on a rate. And if inflation is moving closer to 3% from the PCE number, I think it was 2.6 today, if that pops over 3, they're not going to do a cut in rates in September. The wild card would be if you saw tariffs really push through inflation higher, 3.5%, 4%. The wild card that nobody's even thinking about is, would the Fed increase rates? And I think that's a risk that people should now include as a possibility if the tariffs really become significant increases and we're seeing consumers pulling back because of the price of it, and I think we're going to see more of that. Well, look at the price of meat. Look at the price, but that's domestic. But you go in and buy anything that's if it's manufactured in Asia, via Vietnam or China, we're already starting to see retailers saying that the new goods are coming in with the tariffs, prices are going up, and they're saying that in their Q2 calls.
Do you think Canada and the U.S. should get out of NATO?
Well, I think the U.S. is likely before we are. I think Carney likes being closer to Europe. He's talking more and more doing things with the EU. He wants to find markets in Europe so we become closer there. He's in NATO already. His defense spending is minuscule, so he's got to ramp that up. And, I don't think he's going to get to 5% while he's running the country. The United States may say, look, you guys take care of yourselves. We don't believe Russia is going to invade Europe. The only reason NATO's around was created was to protect against the Warsaw Pact. That's not an issue anymore. I think Martin's covered that really well with you in your previous interview with him. And so my view is that the U.S. should not be subsidizing NATO, and they should be saying we don't need NATO, and you guys take care of it in Europe. We need to balance our budget, and we don't need all these troops in Germany. We don't need all these troops in South Korea, and as they retrench, defense spending can come down, and Europe will have to take the burden, and South Korea will have to take the burden for their own defense.
Do you think President Trump has a plan to deal with the U.S. debt?
Not in his lifetime. I think it's ridiculous. They just spend. Defense and the border are ones that the American public want, but all the spending that's going on, for other things, be it Bitcoin, be it the spending to fix up the White House. His recent trip to Scotland went on the taxpayer dime, even though he went there to golf and had a meeting with Starmer and the EU. Hey, let's have an hour in between my golf games. It's ridiculous, and Congress doesn't have a fiscal backbone So the deficits are just going to continue. The debt levels are going to grow. They're going to have to pass a limit to increase the debt at some point. But the bottom line is, until the American public, get angry enough and say, live within your means, don't take our money and spend it on stuff we don't agree with, like all the Doge thing, not the Doge things, all the, the stuff that was going for, in the foreign countries, on issues that were brought up that people said we're not, you're not taking care of Americans and you're willing to spend more money on foreigners on things you won't spend money in the States. All of that kind of stuff is stopping. But the bottom line is when you're bringing in, $4 trillion and you're spending $6 trillion, the numbers just don't work at some point. And whoever, are people, are they going to be willing to continue to buy treasuries and let you live beyond your means? At some point, that the system, when you're spending of the $4 billion that you have, $1 billion is all interest.
Do you think Prime Minister Carney is out to economically destroy Canada? One example being subsidizing the employment costs of immigrants while destroying opportunities for the youth of Canada.
Well, this immigration, thing is very, very costly. Hotels that they're being put up in, and yet you have people on the street that don't have homes and can't find a place to sleep at night, and yet so Canadians are questioning that. Senior citizens, are not getting equal treatment to what the immigrants are getting in terms of health care, and then the youth opportunities. The job opportunities are not there because the economy is stagnating. It's barely functioning, growing, and housing is a problem because of the increase in the population and not enough new homes being built. So you've got quite a lot of tension in the country, and the government of Canada is trying to keep a lid on the protests, and people are upset by the fact that there's not equal treatment between the new people coming to Canada and people who've been all their lives in Canada. And again, it's an issue that is perking up more and more, and the frustrations are there. And weak economies, if we have a weak economy, that will even get more pronounced as people will say, there's no fairness in the system, and they reject the government's policies, and fiscal restraint at some point will come to bear. And, why should Parliament keep on increasing wages faster than wages in the private sector, with all the perks and, pensions, all that stuff? People at some point are just going to say no more of this. And it hasn't come yet, but it's likely to come at some point in a weaker economy. If somehow the pie gets bigger and everybody sees a benefit from an expanding, wealthier economy, then those tensions disappear. On the other hand, if it's a weak economy and people are losing their jobs, because the companies are not profitable, of course we saw the Bay go under. Retailers are having trouble. AI is going to take jobs away, and for your unskilled, labor, So to me, all of that tension could make things very difficult for the government in power.
President Trump is going to tariff Canada 35% over fentanyl production being dumped into the U.S. Do you think Mark Carney will side with the drug cartels or President Trump and the people?
When I read a lot of articles about fentanyl, maybe the precursors are coming in through the port of Vancouver and going south. But I don't think, the Canadian fentanyl problem is the same as Mexico's. I think Mexico's is much worse. But again, Trump wants reasons to force Canada to become the 51st state. So he's just grabbing on fentanyl, even though the numbers may not prove it. So I don't think he's in support of the drug cartels. I think it's his desire to keep Canada close to the United States and capture our resources cheaply, I think the high tariffs that we're looking at will, of course, are steel and aluminum, which we know about. Forest products for years has had that problem. And, I think that those, and of course, energy right now doesn't have those tariffs. So the question is, does the, USMCA deal protect a lot of jobs in Canada, or does Trump push the button because he's not happy with Carney over the decisions politically that he's making closer to the EU, supporting the Palestinians when he's trying to get a peace deal with Hamas and Israel? So there's a lot of geopolitical tensions here, and Trump's going to use the power of the purse, i.e. access to the U.S. market for selling into it as a way to get what he wants on these other issues.
What's the latest on U.S.-China trade?
Dragging on. China, there's so many issues, related to, as you said, fentanyl, theft of intellectual property, the TikTok issue, the auto industry issues, access to markets by American companies into there, China subsidizing many of their industries so they can manufacture, keep people employed, and then dump the product on the global markets. So there's a lot of, that big trade deficit the U.S. has with China cannot be made up just by China buying more oil and propane and agricultural products. There's got to be a major change. Boeing, as I said before, China says, I'll buy a new 100 planes. They won't get delivered during the Trump term. So I think that the U.S.-China trade thing is not an easy one to fix. And I think China is trying to say, look, the America for a long time was the global power. We, China, are also a global power. We have a bigger population. We're not, our economy is getting up to yours over time. And we have a better EV business. We have a lot of things. We have all the critical minerals. We have the majority of those. So back off. And one of the big issues is going to be Taiwan. The Americans have been, for saying that they're going to support Taiwan. China sees Taiwan as a breakaway province. At some point, most military experts are saying China will move on Taiwan. Will it do it by blockade so there aren't deaths and destruction, or do they do it by invasion, which would be, and of course they're building up their forces to invade. So Taiwan is a powder keg at some point, maybe not now, maybe 5 years from now, but at some point, China, just like they went after got Hong Kong and Macau, they're gonna end up with Taiwan, either by a peaceful agreement with some autonomy like Hong Kong has as a business place, not as restricted as the mainland, but something may happen there. And again, if they blockade it and cut off Taiwan semiconductor shipping to the world, that would be a major blow to global economies, to the AI industry, and probably severely impact the stock markets.
The Canadian dollar has been pulling back. What do you see ahead for the Canuck buck?
Again, it's our export surpluses. So if we have a lot more energy exports to the States, and if the price of oil is high, so if we're looking at $69, we're 72, 73 cents. If we back into the low 60s, we'll break 70 cents. On the other hand, if we into 2026, if I'm right that we're $75, $80 WTI, I think we could bounce over 76, 77 cents on the upside. So it really is. There's a very high correlation between WTI prices and the Canadian dollar, because it's our biggest export surplus. I think that people should just keep an eye on what's going on with WTI, and if it weakens, expect a weaker Canadian dollar, and vice versa next year, when I think we're going to see stronger oil prices heading into the end of the decade, because we're not producing enough, and if demand grows by 1 million barrels a day, and it's not going to be in the OECD where demand grows. The OECD demand is probably going to fall off because energy efficiency and electricity more from natural gas propane use, etc. That the growth is going to be in the third world, where they're going to bring on copper and nickel, lithium, all those things. So parts of Africa, parts of South America, parts of Asia will see increasing consumption by 6 to 8 million barrels by the end of the decade, but you might lose 2 or 3 million barrels a day in the OECD, netting an increase in demand. And right now, not enough money is being spent to offset depletion, so you're going to need to see much higher prices to attract capital to bring on more oil production to meet that global need over time.
With electric vehicles becoming more popular, especially here on the left coast, are traditional oil and gas companies getting involved in the battery metals space?
No, I think if you remember, ExxonMobil at one point owned a battery company or batteries in years, probably decades ago. But no, they're not in that. Some of the, infrastructure companies are involved in wind and solar and stuff like that. But I don't think the traditional energy industry companies are going to do that. Geothermal maybe, but not much more than, they're not going to get the batteries. Again, the cost of entry for the batteries is very expensive. Getting the support from the government levels, getting the end users integrated, all of that is a big different business than finding and bringing on crude oil, natural gas, geothermal. So I really don't see that happening. It's a totally different business. And any company in the oil patch, the big multinationals that have diversified. Remember Beyond Petroleum for BP? Well, that didn't work, and now they're back to being an energy company. And you've seen Repsol and other companies in Europe taking a 180-degree turn. That maybe that's not the business they should be in. Maybe their view that energy demand is going to decline and that we're past peak oil, that may not be the case.
Where can our listeners subscribe to the Schachter Energy Report and find out more about your upcoming energy conference?
Well, as I mentioned earlier, www.schachterenergyreport.ca for the website, and you can just go there and look at the options to subscribe. And if you do subscribe, you'll get Eye on Energy directly from us. And also there's information there about getting your 2 complimentary tickets to the conference, which is going to be a much more, every year it gets better and better. And so I think we're heading that way this year again. We're going to have a panel at the end of the day with industry experts so people can ask questions of the industry leaders from the drilling side, from the service sector side, and the E&P companies, and get that input. And again, things are changing so much, so that'll be very valuable. And then we always open it up with somebody on the political side, which we're in the process of negotiating. And then we have 9 rooms that run 5 sessions each, so we can have up to 45 companies. And our goal this year is to get over 40. And then that's going to make it for one of our best conferences yet. And access to management, I think, is the real value. To talk to the senior CEOs of Birchcliff or Step or Tourmaline or Bonterra, or any of those kind of Touchstone, Logan Energy, Southern, Alvo Petro. Let's just go through the list. They're all on the website. All of these are very, very important. Topaz will be there, which is in the infrastructure area. Freehold, a royalty company. Freehold, a royalty company, will be there. So people who want income can find companies to talk to and get to know them better. So there's a lot of great variety in the program. And so I think people, if you own energy stocks, if you want to be more comfortable with the names you own, if you want to listen to stories of companies you thought you might want to buy, it's a great opportunity. And most of the people come, are individual investors who may have large parts of their portfolio managed by, investment dealers or, some of the big money managers in the country, or by mutual funds. But a lot of them might have their TFSA or other funds that they manage themselves. And so they want to have their fingers knowing the companies, talking to the companies. So this is a great opportunity to get to know them. And maybe some of these companies that are there are owned in your major portfolios as well. So it's a great opportunity. And every year we get more and more attendance. So those who would like to come, either buy the tickets directly or become subscribers, and then you can get a chance to come and see how valuable this is for your knowledge as you go through the investing cycle in the energy side.
Joseph, thank you so much for being on This Week in Money.
Oh, it's always a pleasure to be with you, Jim.
My guest has been Josef Schachter, founder of the Schachter Energy Report online at Schachter.Energyreport.ca. He was speaking to us from Calgary. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Martin Straith, and Josef Schachter. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@HowStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen.